Hello and welcome. Today we're going to look at Eli Lilly. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results. We'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarize our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. And this is down by minus 16%. Now let's look at the free cash flow, which is the money a business can generate from its operations. Eli Lilly's free cash flow is down by 46%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. And revenue has increased by 12% last year. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. And for the last 12 months, Eli Lilly's book value has increased by 24%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital and return on equity are up by 22% and 68%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. And their debt is incredibly high, as it will take them nearly 32 years to pay it off with their current free cash flow. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. Gross margin is excellent at 79%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Operating profit margin is good at 19%. Now we're going to look at the free cash flow yield, which is a financial ratio that compares the free cash flow per share of a company against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. At 0.12%, the free cash flow yield looks quite poor. After that, we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. And lastly, we come to the enterprise value divided by earnings before interest and taxes. Like Peter Lynch, Joel Greenblatt uses this metric to identify if a company represents value for money. The PE ratio is 126 and the enterprise value to EBIT is 104, which makes these very high. We'll come back to Peter Lynch and Joel Greenblatt's valuations later on. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 10 super investors who own this company. If we look back at Joel Greenblatt's previous sales and purchases, we can see he has both bought and sold shares in Eli Lilly, but in the last 2 quarters he has bought 6,000 shares. However, 6 other super investors have sold shares. Pollen Capital has bought 624,000 shares and then sold 29,000 shares in the last quarter at a profit. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. Over the last decade, we can see that Eli Lilly has slowly started to make progress, but in the last 3 years, it has made some rapid progress. On average, the analysts believe that the price target should be about $714, but some believe it can go as high as $1,000. Analyst reports suggest that Eli Lilly is currently overvalued, and the overall consensus is that Eli Lilly is a strong buy at the moment. And collectively, the analysts believe that the company will continue to grow between 30% and 35% over the next 5 years. So I will use the current earnings per share at 5.80 as my starting point when creating a valuation. Based on a combination of past growth and future analyst predictions, I'm going to estimate the earnings per share growth will be about 30%. I'm going to give them a PE of 40. After that, I'm going to project these numbers forward by 10 years. This gives me an estimated future stock price of $3,199 per share for its future share price. Then we need to include our 15% return, and then we work out the current value that Philtown calls the sticker price, which is $791. And finally, we apply a margin of safety. At 50%, this gives me a buy price of $396. At a 20% margin of safety, my buy price will be $633. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. Using this model, it suggests that Eli Lilly is currently undervalued. Then we're going to move on to Warren Buffett's 10-cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. At 0%, this suggests it is very overpriced. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. At 104, this suggests that Eli Lilly is very overpriced. Finally, I've also included Philtown's earnings per share growth model that I used earlier. Using this model, it suggests that the current valuation is about right, but doesn't leave any margin of safety. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. In this next section, we're going to split the chart into different zones. Our first zone is the market bottom for Eli Lilly, which is about $315. Then we come to zone 2, which is between $452 and $570. And then we currently seem to be in zone 3, which is between $570 and $785. And finally, zone 4 is anything over $785, which would represent a possible price to take some profits off the table. In this next section, we're going to find out what our potential return would be if we bought at today's price and at our 20% margin of safety. If we bought at today's price of $734 and sold at the market high of $785, we would receive a 7% return. We would see a return of 24% if we bought at $633 and sold at the market high. In this graph, we're going to compare the operating profit margin of Novo Nordisk, Johnson & Johnson, United Health Group, AstraZeneca, and Eli Lilly. By comparing the operating profit margin, we can see the relative performance between Novo Nordisk and its main competitors. And the chart tells us that Novo Nordisk are significantly more effective at generating profits from their core business activities, and therefore better positioned to protect themselves during any economic downturn. Finally, let's summarise what we found out about the company. When reviewing the key pillars, Eli Lilly scored 6 out of 12. Under ownership, 10 super investors have bought in the last few quarters and 6 have sold shares. In the past 10 years, we can see the average share price has trended up. Analysts are indicating that Eli Lilly is a strong buy, and they're predicting that they will grow between 15% and 43% over the next 5 years. Using the different valuation models, my personal buy price is $633 per share with about a 20% margin of safety. My final overall rating is 2.5 stars out of 5, and I have given this a category B rating within my own stock watch list. This company does have bags of potential, but to be honest, if I had to choose, I would choose Novo Nordisk over Eli Lilly due to their better fundamentals. If you would like to see my stock analysis of Novo Nordisk, please click on the link at the side. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.